for people who are investing through a self-directed IRA account? Can you, take that $50, $100, $200,000, invest it in a debt fund, and then, since you don't need the cash flow right now, just let it continue to compound and grow. I think people would be really surprised that, say, if they took $100,000 or $200,000 and put it into a debt fund and got, say, an 8% preferred return. Do you know what the internal rate of return on that investment would be in 10 years? It'd be 17% or over 17%. So wow. You can get a nice, compounding. What did Einstein called it the eighth wonder of the world. It really is.
Welcome back to another episode of Keeping It Real Estate. I'm your co-host, Mike Roeder, and today we have Whitney Elkins-Hutten on the show again. She actually had joined us back on episode 72, so if you haven't watched that show, make sure to check it out. And if you don't remember, Whitney's a real estate expert. She's a past podcast guest. She leads investor education over at passiveinvesting.com, lives out in Boulder, Colorado, and they're currently managing $1.3 billion of commercial real estate in their portfolio. And again, make sure to go check out her show, Passive Investing Made Simple. She shares some really good insights on real estate wealth creation. And with that, Whitney, welcome back to the show.
Thank you so much for having me. And I guess I'll update a stat there. We have over 2 billion assets under management now. So
that's incredible.
Well, I should say 1.4 assets under management and done more than 2 billion in transactions. So
wow. Well, that's fantastic. I'm excited to chat a little bit more about that. And, just for anyone that doesn't remember episode 72, can you share a little bit of your background and how you got into real estate investing, Whitney?
Yeah, absolutely. Well, as you said, I'm the director of investor education here at passiveinvesting.com. I also have a coaching and mentorship company called Ash Wealth as well. I'm the founder there. I'd like to say that I went to school in real estate and have a business degree, but that's not it at all. I started off in real estate completely by accident back in 2002 when I bought a house with a significant other, and about a month later, the relationship fell apart. And I had a house. I thought it was going to sink me, and learned how to rehab the whole property and, out of a book. A Home Depot book because YouTube didn't exist back then. And so I got a little scrappy, paid my friends in beer, sushi, and pizza, and we put the house back together. And I sold it, which is probably my number one investing mistake. Because when I sold it, I was super excited at the opportunity to have be free and clear of the house, have $52,000 in my pocket. But at the same time, I realized I had eliminated my housing bill with my roommates. I was making money every month. I could have used the equity in the house to buy another property. And dang. Anyways, kind of learned some things the hard way there, but eventually scaled a 36-unit rental portfolio. And then did a small multifamily building in partnership with a few other partners. And then kind of hit a ceiling of achievement. We had a baby girl at home. Both my husband and I were working full time. And I was like, I can't imagine, trying to manage even the property managers on all these assets. We have to start going to larger projects. And then that's when I went into private equity real estate and, spent several years on the capital raising side of private equity real estate, was the general partner on several multifamily projects there. And then COVID hit, and we wanted to have more time and flexibility to travel the world with our family. Also homeschool at the same time, or school from home. But anyways, here we are today. Majority of our portfolio is in partnership with other people, actively and passively. We have personally, my husband and I have over 6,500 residential units, 2,200 self-storage units, and a myriad of other businesses that we oversee and manage.
That's fantastic. Well, thanks for sharing a little bit about your background. And I just want to rewind a little bit. You had said your first property, you flipped it, and that was one of your big mistakes. You wish you would have held on to it longer. And, I think a lot of people may have that mindset where it's get in, get out pretty quick, whether it be a single family or multifamily property. And, just the power of refinancing a deal, that's tax-free wealth. So if you refi a deal and let's say you stuck in $200,000 and you get $150,000 or $200,000 back, that money is not typically taxed. And then you still have that cash flow and you're still able to build that equity. So I love that you mentioned that. And then you mentioned in there that you switched to larger assets. So you had been buying, smaller multifamily, it sounds like, and it was, you're putting in quite a bit of effort and time, it sounds like. And so you shifted over to larger properties where I would assume that you were able to implement third-party management or have your own management company kind of take over operations. Is that correct?
Yeah. Each evolution of our portfolio, mind you, this is over 22 plus years of investing. Yep. So that little 60-second synopsis, covers about 22 years of investing. But at each evolution of our portfolio, doing the live and flipping and house hacking, and transitioning into single family rentals, it was all about leveraging up our time. And so, the first part of our investing, the live and flipping and house hacking, taught us that we could unhook our value from the time that we spend in the world. And so that we didn't have to trade time for dollars. And that was amazing. Then we got the single family rentals, the small multifamilies, and eventually the one multifamily building. We had elements of scale, but we still were pretty much in the weeds. I'm handling all of the financing. I'm handling all the day-to-day operations in conjunction with the property managers. If there's a break-in or a water heater, insurance claim, whatever, I'm handling all that, even though there is property management in place. And I'm like, okay, well, we need to go bigger in order to, again, get leverage, meaning that when you have larger properties, you can actually hire on-site maintenance, you can have a team, you can have an accounting team, you can have a legal team, you can start, creating a leverage that you can only get through building a team through a business. And so that was really kind of why we started doing that, moving up into the larger institutional grade properties, because one, we could have the team. Also, too, the valuation of the property was very different. When we're doing our fix and flips and even our live and flips, the valuation of those properties were only based on what somebody sold their property for in the past 6 months. It's called a comparable analysis. Whereas I'm in the larger institutional grade space now, there is a little bit of element of market pressure there, but largely if I can increase the net operating income on that asset, i.e. make more profit on it, it is inherently more valuable to the next buyer. And so that was, you're in much better control of your destiny that way, I feel.
Yep, 100%. I'm completely on board with that. And, I know your investment strategy, obviously, it sounds like it's changed a lot throughout the years, going from single family to multifamily. You've gotten into multiple other commercial, asset classes as well. I'm curious, we had you on about a year ago on episode 72, and we talked a little bit about your investment strategy then. Has anything changed over the last 12 months? Because there's been a lot of change in the market, whether it be multifamily or retail or what have you. I would love to hear if anything's changed on your side.
Well, fundamentally, as far as our personal portfolio, not much. I mean, we still have our, larger institutional grade assets. We're constantly working to reposition those in this environment, keep them stabilized, until interest rates drop and asset prices start increasing again. But they're well positioned to kind of ride through the quote unquote storm, and that just is a testament to our operations team in order to keep those properties stabilized. As far as like other asset classes that we're personally adding into our portfolio, we're continuing to, identify good equity projects, both of multifamily in self-storage and express car washes. And, we're continuing to just methodically add those to our portfolio, both at passiveinvesting.com, but also personally. And then I would say the one thing that we have done personally a little bit more of, and I would say even professionally at passiveinvesting.com, is taking a larger debt position. So, us personally, my husband and I, we have more allocation of our portfolio ever in real estate debt than we have been, because there's been a vacuum there. And right now, with interest rates being so high, it's being the debt provider is being rewarded for that. And so we're seeing the same thing professionally at passiveinvesting.com with our real estate debt portfolio. We have a couple other debt opportunities that we'll be releasing here very soon in the medical office space and the like that we're super excited about. But this is a really great time to be the bank with interest rates being so high. And, what that allows you to do is harvest a regular monthly or even quarterly income from those projects. Now, we trade that for other wealth pillars, like, if you're on the debt side of things, you're not getting the tax benefits. But right now, for somebody who, has seen that cash flow compression and the equity side of their portfolio bumping up the debt side of their portfolio to account for that cash flow, that drop in cash flow can be a really great opportunity to, put stagnant cash to use, for the next 12, 24, 36 months until the market cycles again and we start seeing, that spread there, that cash flow spread, start to occur again in the multifamily and self-storage space. And so those are things that I love. We're doing personally, we're doing professionally at passiveinvesting.com. And also, if for somebody who's just starting out as an investor and they would go, what did she just say? That these are concepts that I cover in my book, Money for Tomorrow, too.
And we'll talk a little bit more about that in just a bit, which I'm super excited about. Going back to the larger debt position, I love that. I love, diversifying your portfolio. Any tips for investors out there on what they should look out for when getting into a debt position? Because it's new to a lot of people. Like you said, there's a lot of wind at the sails right now in that industry. Any suggestions there? Any tips?
Well, I can share what I look for from a debt position, what I consider to be one of the most conservative positions you can take. Because the thing about investing in debt, I talk a lot about the 7 pillars of how you build wealth. Capital preservation, cash flow, equity growth, tax benefits, smart use of leverage, inflation hedging, and expert operators. Whether you're the expert or you invest with an expert operator. When you move from equities to debt, you're giving up some of those pillars. So the pillars you are maintaining, like capital preservation, cash flow, expert operations, those have to be, you have to double down on those pillars, right? The fewer wealth pillars you have in an investment means the ones you do have to be incredibly solid. And so when we think of it from this type of approach, capital preservation, I want to be in a first lien position on the property. I want to be at the bottom of the capital stack, depending on how you look at it. I want to be the first in line. If something were to go wrong with that asset, I want to be able to snatch that back up and take control and not have anybody else competing along with me on that. So first lien positions, I feel right now in this environment are very critical. But first lien position on what? A high quality asset. You want a high quality asset and you want a high quality borrower as well. Because your objective with a debt position is not necessarily to take over the asset. Your objective with the debt position is to be the bank. And the bank does not want the asset back. The bank just wants the cash flow to come in every single month. They don't want to be the operations manager. So those are, a couple of things to think about there. Another thing that I would really watch out for here. So we talked to, you want a high grade asset, high grade borrower. You want to be the first lien position. And then another just kind of really quick tidbit, and we can dive down any of these rabbit holes if you want to, is making sure, especially if you're going to go into a debt fund, that the fund, when you enter the fund, you're allocated across all the loans in that fund. So you're getting instant diversification, okay, across loans, borrowers, markets, right? That's great. Also, you want to ensure that the fund does not use leverage, because that puts you just in a similar position. Like, if the fund is taking all of the capital that they've raised, going to the bank, getting a line of credit to bolster how much they're able to lend out, now you put yourself in a risky capital position. Okay, now sometimes these funds will have small lines of credit, and that just helps them smooth operations as they have liquidity events. That I think is okay. Still not my favorite, but I would look for funds that use very limited to no leverage in their fund, because that's the most conservative position. And then you also want to look for, flexibility in how you want to use these funds. Is it going to be a short-term position for you? Do you have, say, a 90-day or less liquidity option, meaning that you invest in it and then you identify an equity position you want to go into? Can you liquidate, in 90 days to get that cash back? And also, can you get compounding? That is another amazing thing about a debt fund. For people who are investing through a self-directed IRA account, can you, just, take that $50, $100, $200,000, invest it in a debt fund, and then, since you don't need the cash flow right now, just let it continue to compound and grow. I think people would be really surprised that, say, if they took $100 or $200,000 and put it into a debt fund and got, say, an 8% preferred return. Do you know what the internal rate of return on that investment would be in 10 years? It'd be 17% or over 17%. So wow. You can get a nice, compounding. What did Einstein called it the eighth wonder of the world. It really is.
That's incredible. Thanks for sharing all those tips. I appreciate that. And, I would like to shift over to the different asset classes that you mentioned before. So self-storage, car washes, multifamily, debt positions were kind of the four main avenues that you guys are taking right now. Which of those do you like most? Is there a certain niche that really stands out to you in today's environment? And has it changed over the last couple of years?
I will definitely say it's changed over the last couple of years. But this is kind of how I think about it. Personally, I'm looking to build a core portfolio. And when I look at my customer, what does everybody need? They need a roof over their head. They need a place to live. We are so undersupplied by housing by millions of units. Now, this isn't everywhere in the United States. Real estate is so hyper local. So you have to look at supply demand metrics. So we want to make sure that you're investing in markets where the supply demand works in your favor. Mm-hmm. Now, multifamily has been a little cash flow compressed. Okay. And that will soon cycle back out in the next year or two. I firmly believe there's, some macroeconomic, trends that we can talk about there, but building a core portfolio in multifamily. Now, if somebody's just entering the space, they might go, "Hey, Whitney, fantastic, but I need cash flow." Well, then let's step out to the outer side of, right past that. What does now your customer need? Well, we Americans are so attached to our cars and to our belongings. That is the next logical, place to kind of invest in. And so self-storage makes sense. Express car washes makes sense. And ironically, and most people think express car washes do well when times are great. They actually are very recession resilient, much like self-storage, because when times are tough, people have to take better care of the cars that they have because they can't go out and get a nice loan to go buy a new car. During COVID, you could get a 0% loan for 96 months. Today, a car loan, we just bought a camper trailer, a little different. And it was 8% or 8.5%. And we're like, woo, that hurts. That hurts a lot. But anyways, so those are a couple of things to think about. And then, I would also think about supplanting or allocating part of the portfolio to debt instruments, as we just discussed. So if you need cash flow now, you can get the cash flow now from the debt instruments. It also operates kind of like a hedging, say like a bond hedge in a way, a little bit more conservative position. If you invest in conservative debt, right? You can invest in risky debt too, but it can, that can help, smooth the ride in your portfolio over time. So again, which one do I like best right now? I think from a cash flow perspective, debt is very interesting. And then also express car washes are going to be probably one of the higher yield assets that you can see out there.
Got it. Well, I appreciate that. And yeah, like you said, a lot has changed over the last couple of years. I would be interested to hear a little bit about any significant trends that you're seeing in the real estate investing space right now. Again, a lot's changed over the last couple of years. What are you seeing today in today's market and going forward?
Yeah, in today's market, from a limited partner perspective, being with high quality operators is an absolute must. We've been talking about, at least, from an educational position, that, when you invest in a limited partner opportunity, that it's all about the jockey, not the horse, right? I think this is even more, relevant in today's environment. So there are a lot of operators out there that are struggling. And not just like they've paused a distribution or two on their properties or anything like that, but really struggling. So you want to, as a limited partner, take great care to really truly vet the operators you're investing with and make sure that their portfolio is sound and that they are in a sound cash position as well. You want to be in markets too, that are, great growth markets. So again, we're kind of going back to fundamentals, but I think even these fundamentals are just so much more important right now. We want to be in markets where the supply and demand um, is in your favor. There's been a lot of things in the news saying that multifamily is completely overbuilt. Absorption is going to take 12 to 18 months. That is true. Okay, there's some, we might see a small decrease in rents in some markets, and potentially large decreases in markets as, these apartments are being delivered. But once that supply is absorbed, there's nothing in the queue in the majority of these markets behind there. So you have to be well positioned. This goes back to the operator. They have to be well positioned to kind of ride the ride for the next 12 to, 18 months as that absorption occurs, and then you're going to be well positioned, in some of these markets to be able to really, ride the next wave up. Um, but we're undersupplied on housing. We're that's soon to be exacerbated as this multifamily supply is absorbed. We're seeing a great wealth transfer that's happening right now. I mean, there's so much equity that is sitting on the sidelines, so much capital sitting on the sidelines being ready to deploy. And so, what is that going to do to asset prices? I think, a lot of people are really hoping that asset prices fall. I don't see we're going to see a massive drop off in the asset prices because there's so much capital sitting on the sideline ready to go into these projects. If somebody's sitting on the sidelines, like waiting for 2008 to occur and waiting to pick up a barrel full of really distressed properties, they may have a real reckoning, here in the next 12 months that doesn't actually really occur. There will be some distress. We're already seeing it. But, the massive distress we saw back in the financial crisis, I don't think this is.
Yeah, I completely agree with that, Whitney. It seems like some distress is coming down the pipeline, but it's not a massive amount. You're seeing a lot of groups that are jumping in and, either bidding up or, just trying to deploy capital into these distressed assets. And what I've also been hearing from a lot of brokers and lenders is that there's been a lot of workouts, in the multifamily space and other commercial asset spaces. And so I agree. I don't think you're going to see a huge collapse like you did in 2008, 2009 with the single family space. And it just seems like a great spot or a great point to jump in when asset prices have reduced, 25 to 35% in the multifamily industry. Have you seen that in the self-storage space or the car wash space as well, or just multifamily?
Um, you know, Multifamily and self-storage have some similar, issues that are happening with them, from a debt perspective. In some ways, self-storage really hasn't been talked about as far as like the distress and the debt that's there. But the business plan of the self-storage facilities are generally longer. They're usually like 7 to 10 year business plans. And
Mhm.
so, as long as the debt, that's currently in place on the property is, going to last another 2 or 3 years before it has to be repositioned. I think that maybe that fallout comes a little later, if at all, because, if they can ride the weave, those operators can ride this kind of bump in the road, so to speak. They'll be able to, as interest rates start to fall, Jerome Powell's already indicated, while they're holding rates right now, we're recording this at the beginning of April 2024, they do anticipate 3 rate cuts this year. So rates will, and all signs point to, yeah, start to fall probably like in, latter Q2, Q3 this year. That will give an ample opportunity for, some of these operators to either move from construction debt, bridge debt, into more permanent debt, or perhaps if their debt is coming due, refinance into more permanent terms. Long-winded story to say, like, multifamily and self-storage are having similar, issues occur in those spaces from a debt perspective. It's just that I don't think, self-storage, because of the business plans typically longer, it's not as grave. Now, express car washes, that is, really an interesting trajectory. It's on the way up. It's a, $38 billion and growing industry. We've seen there is, um, there's a lot of growth in the major metropolitan service areas, but people live everywhere and they have cars. So there's a
Mhm.
complete population that's being underserved in the secondary and tertiary markets. So, don't tell anybody because the cat, we don't want the cat out of the bag, but we really love those secondary and tertiary markets where, we can essentially build a facility that's right in the traffic pattern of the Saturday morning, errand running. Imagine somebody going to Walmart or Target and there's one of our car washes parked on an out parcel right there, and they can just get, pick up their groceries, do their shopping, get the car clean, pick up the cleaning, and away they go.
I love it. That's amazing. Well, I appreciate you mentioning that. And, Whitney, any advice for investors that are just looking to get into real estate investing, that are new to the game? Any advice for those individuals?
Well, this is a great time. Well, it might be a little bit challenging to find, the perfect opportunity, that you probably heard about here about 4 or 5 years ago. This is still an amazing opportunity to get into passive real estate. It's invest in real estate and wait, not timing, when's the best time to invest in real estate. So this is a great time to complete your education, get with the best operators out there, learn the growth markets, the differences between the markets, for the asset class that you want to be in, and then learn how to invest, vet a deal. I do a masterclass every week called Passive Investing Made Simple. And you can go to passiveinvestingwithwhitney.com and register there for the master classes. And, really that masterclass is just designed to help, investors become confident in going into their first or next investment.
And I think that's so important, just being able to understand who you're investing with and also what you're investing in. Take a look at the numbers and be able to understand those numbers as well. So I appreciate you mentioning that. And, before we wrap up today, tell us a little bit more about your book, Money for Tomorrow, How to Build Abundant Wealth and Protect Generational Wealth. I don't know if I pronounced that right, but if not, correct me. And I'd love to hear more about it.
Yeah. So if somebody's looking for the title on Bigger Pockets or on Amazon, it's released both there in both of those places. It's Money for Tomorrow, How to Build and Protect Generational Wealth. This book, I wrote it actually for an audience of one. I wrote it for my daughter because as my husband and I scaled our real estate investments, there's so many lessons and learnings that we had over the 20 years plus of investing that I really wanted her to not only be able to steward the portfolio that one day that we hope that she inherits, but at the same time we wanted her to have the knowledge, right? Because we didn't want her to have a portfolio and then just live off of the fruit of it. And then what happens to it at the end of her generation or by the next generation? We wanted her to be a good steward. And so I couldn't find a resource out there, kind of all in one stop blueprint. So I was like, well, heck, if I can't find it, I'm going to write it. And so this is all about the lessons and learnings over my 22 years of investing. But also a compilation of kind of quote unquote, war stories from settling 5 estates within my family, my grandparents and my parents, and just, helping people understand that even the common investor can, if they learn the game of generational wealth, what that is, understand the 4 main rules that you have to master in order to win at generational wealth, and then understand the strategies in order to implement each of those rules. Hopefully I can avert somebody from losing $10, $50, $100,000 or more when they, go to settle a loved one's estate, because that was really painful for me. Not only just losing those people in my lives, but that was over $700,000 of loss across all of those probate settlements and trust settlements. If you break out a compounding calculator, compound that out, it's 30 years at 7%, the average market return, that's millions of dollars. If I can help just one person avoid even a fraction of that loss, that's the impact that I want to create in the world. But it requires that you know the rules of the game, understand the game, first of all, know the rules, and understand the strategies, because the news talks about tactics. What's the next stock pick? Do we go to short-term rentals or do we do multifamily? They all talk about the tactics. We need to understand from a global perspective, a strategical perspective, why do this type of investment strategies actually work at building wealth? And then how do we hold on to it?
Exactly. That's amazing. Well, I applaud you for writing that book, especially for your daughter. And, anyone listening right now, make sure to check out that book. Like you said, it's on Amazon, Money for Tomorrow, How to Build and Protect Generational Wealth. And Whitney, before we part ways, how can our listeners reach out to you and get a hold of you if they'd like to do so?
Absolutely. You can find me at passiveinvestingwithwhitney.com. I've got some free goodies there for you, like how to get into your first passive investment. You can also register for our masterclass there, and then of course you can get in contact with my schedule, and we can talk about all things real estate.
Perfect. Well, Whitney, thank you so much for coming on the show. And thank you everyone for tuning in to another episode. We hope you found it informative. And if you did enjoy the episode, we'd be thrilled if you can share it with your friends, family, or anyone you think that would enjoy it. Your support means the world to us. And make sure to subscribe so that way you can keep posted on our future episodes. Whitney, thanks again for coming on.
Thank you so much, Mike. It was such a pleasure.